joining us this morning. Cindy just put out there in the chat. Feel free to, Whitney and I want this to be very interactive. If you have questions, put them out in the chat. We will answer those questions when we kind of get a stopping point between our slides. But you'll get more information from the questions that you guys ask. Is how we present better. So please do ask the questions. One other thing real quick, if your name is not on your screen, so we're going to send the slideshow to you after the presentation. And so if it doesn't have your name on the slide or on the screen, I can't tell who to send it to. So if you would just drop me, you can send me a private message if you'd like in here, or a private chat message, and we'll get you that presentation at the end of the day. So my name's Ben Evans, and I'm an SBDC advisor based in Ponca City at Pioneer Technology Center. I love the presentation because I was a lender for 14 years, so it's something that I understand very well. The main presenter for this is Whitney Randall. She was born and raised in Oklahoma. After graduating from Oklahoma State University, she was able to cultivate her passion for helping people with their small businesses by taking a position with the community bank in Oklahoma City.
Recording in progress.
She has now been in banking for almost 10 years and accepted a commercial loan officer position at Citizens Bank of Edmond 2 years ago. She received the honor of the Next Gen 30 Under 30 Award and has served on numerous nonprofit boards over the years. The biggest joy in her life is spending time with her husband of 5 years, Chad, as well as their 4-year-old son, Dylan, and 2-year-old daughter, Hayden. So I'm going to go ahead and share my screen here.
Thank you, Ben. Welcome, everybody. Super happy to have you here. I'm just going to reiterate what Ben has already said. We want this to be interactive. We want you to ask questions. This is a conversation between you guys and us, and we want to be a resource for you. So I will tell you at the end of the presentation, you will get my contact information, including my email and my cell phone number. Feel free to give me a call, email me if you have any questions. I also, people always have questions talking to other banks and things like that, and I'm more than happy to be a resource for that as well. So like Ben said, I work here at Citizens Bank of Edmond. We do quite a bit of SBA lending. So I have the honor to talk to entrepreneurs, small business owners all day, every day. And it is my absolute favorite thing to do. So feel free to ask questions, and I want to help any way I can. So we'll just kind of dive in and see. Let's get started. Oh, Ben,
awesome.
You.
Okay, thanks, Whitney. So what we do is the SBDC provides confidential, high quality, no cost entrepreneurial and small business management advising in order to help Oklahomans start and grow businesses. We're committing to helping grow Oklahoma's economy one small business at a time. You can see here where we're located. We're located all across the state of Oklahoma. We were established in 1984 and serve all 77 counties. Our home office is Southeastern Oklahoma State University in Durant, and we partner and collaborate with universities, colleges, career techs, economic development entities, chambers, and main streets across the state. We are funded by the U.S. Small Business Administration. They provide dollar-for-dollar match with our local partners. State-funded partnerships provide the required match. So you can see our expertise. We're all business generalists. Like I said, mine banking in particular, but we have healthcare, government contracting, ag, a variety of different things. So there is my information and Whitney's, and we will show this at the end again. And so you don't have to worry about writing that down now. So Whitney, please take it away.
Yeah, so this is my favorite place to start. So I will preface all of this saying that I switched from banker hat to small business owner hat. My husband has owned his small business for about 6 years now. And so I will tell you, I practice what I preach. So if you ever have questions, not banking related, but others, please let me know. That's what I'm here for. So this slide really, as the banker, I'm going to kind of talk from the banker side and then talk on the small business owner side. So who's on your team? This is so important to get good groundwork for your small business. So you may be the best person at what you do for your small business, but that doesn't mean that you're the best person to do the bookkeeping. You may not be the best person to do know all the laws, attorneys, things like that. So this is why it's so important to have a good team, because these people are going to help you continue to evolve in your small business and grow and expand and meet those goals that you have. So I always start with the CPA. I'm not saying you need to run out and hire a CPA. I understand you're a small business owner, you're about to start your business, so this is possibly not feasible. But what I would recommend is getting a good mentor, getting someone on your team that may just be a bookkeeper that's doing your monthly financials for you. Because if you are not looking at your monthly financials, you don't know where your business is. And as the banker, that is vitally important. I currently have a client, and their CPA is 6 months behind on financial statements. So there is no way for them to know where their business current's sits. And why that's important for the business owner is because where are you going to make some tweaks each month? How's your revenue trending? Things that you need to be looking at. I'm not saying, again, you need to be an expert in this, but you need to have someone on your team that you can ask these questions to, bounce ideas off of. That bookkeeper or CPA will be able to do different, run different scenarios for you in order to see, hey, I have an idea. I want to start a new area of business. So maybe I'm just doing consulting right now, but I also want to start doing more coaching and things like that. What does that look like layered on top of what I'm currently doing? Am I going to have to hire more staff? Is that going to increase my costs? Those kinds of things. Having someone that you can turn to that you trust for that is very, very important. When I say an attorney, if you're starting a business, you want to make sure that you're protecting yourself, your family, your personal assets. Having an attorney, an advisor for that is very important. My husband and I, we have some rental properties, so we want to make sure that all of that is safe. Like I said, we have 2 kids. We want to make sure that we're taking care of all of us. My personal thing is finding a good banker. And when I say banker, I'm not saying bank. I'm saying a banker. I'm saying a person, someone that you can talk to. I get on the phone with people every day, and it's the joy of my life to kind of talk through different scenarios, what you're doing with your business, how we could help, things like that. And then I always end the call with, who else are you talking to? What other banker are you going to call today, tomorrow, this week to just see what they could offer? And everyone's like, what are you talking about? I would never do that. I'm going to go with you, Whitney. And I'm like, I may not be the best option for you. I may not be the best banker for what you're trying to do. And that's okay. The goal is to make sure that you are doing what's right for you and your business. I have a really good friend, and she's still my friend. She came and applied for a loan, wanted to start her dental office, and I gave her a term sheet, got her approved, all the things. We went to dinner and we kind of hashed through everything, and she goes, well, I just want to let you know that I am going to go with a different bank. They gave me better terms. Are you still my friend? And I was like, that's business. And I appreciate the fact you're being honest with me, but again, that's your livelihood. So if at the end of the day, their terms are putting more cash back in your pocket to grow your business, to make sure your family's taking care of, things like that, then that's what you should do. And that's the conversation that every person on this list should be having with you. Like, what are your best interests? And if I can't meet what your expectations, I'll be honest with you and just tell you I can't. So the interview process for this list of people is really, really important. And I'm saying it's an interview. It is you going in and going, are you a fit for me? And if that person's not, they're not, and it's okay, and vice versa. We have a really great team here at Citizens, and if I don't feel like I could provide the value, not just the lending relationship, but the true value to the relationship, then I will refer you to another lender. Maybe it's here within the bank, and maybe it's not. Maybe I think another bank could service your needs better than what I can, especially if you're not in our service area. We have relationships with other banks, and I can get those referrals for you. I'm going to move on down the list and really talk about an insurance agent, because most people are pretty knowledgeable about what they need on the personal side, but not always knowledgeable what they need on a commercial lending side, commercial insurance side. When you go to talk to a bank and there is a loan involved, there will be certain insurance requirements that you would need to meet, and you need to be able to call up your insurance agent and have that conversation with them. Most of them are familiar with that. Obviously, your vendors who you're using, are they getting the things that you need in a timely manner for the best price, all of that. And then last on the list, which I'm again not saying you have to run out and do this right now, but a financial advisor is really important, because you're creating this small business for wealth. You're creating this small business possibly as your retirement, and you need to make sure you're set up for success on that. One thing that I also recommend, and I love to do, I love, number one, when my clients give me permission to talk to their CPA, attorney, all of that kind of stuff, because that just opens up the conversation where you're now not the middleman. I'm the one that's doing kind of the quarterback of getting the information I need, asking all the right questions, things like that. Most small business owners are like, oh, thank you, finally took something off my plate instead of putting something back on. So always more than happy to have that conversation. I think that's important when you are talking to this list of people. Are they okay with that? What are their viewpoints on getting in a room together? I also think getting, CPA, attorney, financial advisor, banker, all in the same room and going, hey, this is what my goal is for next year. This is what my goal is for 5 years from now. This is my goal for 10 years from now, because maybe you're starting your business and you're going to lease some space in a office building or something. But you want in 5 years, you want to make sure that you're purchasing your building or constructing a building that just basically is adding to your possibly add to your wealth. Well, the banker needs to know that that's on your game plan. The CPA needs to know that's on your game plan. I just talked to a client or a prospect just the other day, and they are looking at wanting to build a home. They're a small business owner. And so one of the requirements is I need to get tax returns. Unfortunately, their business has lost money for the last 2 years. Really great for tax purposes because you don't owe money. Really bad if you're trying to get a loan, because if you're not showing cash flow, I can't loan you money. And spoke to the prospect about it. And I was like, hey, I'm really sorry that I'm not going to be able to help you. Your business lost money. And he goes, well, what do you mean? And I was like, well, gave me your tax returns and you're not making any money on paper. On paper, you're not making any money. And that's what I have to look at. And so his CPA called me and I said, is there any income anywhere else? And that's the other great thing about having that conversation with the CPA, the bookkeeper, is like, okay, what am I missing? Am I missing something when I'm looking at the financials that you could educate me on? Because I'm not going to sit here and say I know everything. And the CPA was like, no, everything you said was exactly right. He didn't let me know that he wanted to build a house. And so I did what I needed to do to make sure they didn't have to pay taxes. And this is where it put them. So having those those live conversations with these people, sitting down at the same table, is so important. So important about all of that. So again, take the time, do the research, find some people within your community. I also want to say the best referrals for this group is from your peers. So if you know someone that's in the business that you're doing, ask them who they use, because the majority of people specialize. Bankers do that. There's some that just do real estate loans. There's some that do small business loans. There's some that do the really, really big $1 million deals. So everyone has a specialty. And so making sure that you're talking to the right people that really know that type of industry is important. And again, the SBDC does a fantastic job on their expertise and referring people to the right people within the organization as well. So lean on them as much as possible.
Whitney, we had this kind of brought up. Dave said, I've always been someone who hates debt. I'm balancing the idea of line of credit versus cash flow. And Whitney's going to talk about line of credit later. Mm-hmm. But my response was sometimes debt is what's needed to make us grow. There's definitely good debt and bad debt. And Patience asked me to elaborate on the difference. And so what I would say, for a very simple explanation on good debt versus bad, good debt is going to help your business grow, be more profitable. It's not a specific type of debt. It might be working capital that we're going to talk about later. We're going to talk about different types of debt, but it may be that you need to hire 5 new employees and you need $50,000 to hire those people to get them started in the job, but it's going to make you $200,000 this year. That would be considered good debt, in my opinion. But if you go out and buy a piece of equipment because your CPA says, well, you can either go buy this $20,000 piece of equipment or you can pay $15,000 in taxes. And you say, oh, okay, I'll go buy it. And that piece of equipment costs you money year to year to run and does not bring you in enough money. That's bad debt, potentially. So it's not that there's any one thing that I will say, I don't like this kind of loan. Is the debt that you're taking on going to benefit your business? If so, I would consider that good debt. If it's not going to benefit your business, that would not be good debt, if that makes sense to everybody. I mean, that's kind of where I meant by good debt and bad debt.
Mm-hmm. Yeah, definitely. So I get this question a lot, and that's why I love talking about it, because, and this even came from my husband, because my husband has debt in relation to his business. And so he's like, what do you guys do in loan committee? And I'll kind of explain loan committee. So this is a really good question when you're sitting down with a banker to ask, say, hey, what is your lending authority? Because every banker has different lending authority that is given to them by the board of directors for the bank. So I have lending authority up to $250,000 with some caveats, policy exceptions, it's collateralized, things like that. So every banker has different lending authority. Then at a certain number, that has to go to loan committee. Loan committee is usually made up of loan officers, the chief credit person, credit analyst. Not everyone's voting, but for instance, our loan committee gets together every Tuesday morning at 9 a.m. to go over loans that are over a certain threshold. If your loan amount is higher than that, then there is called an executive loan committee that meets usually once a week, and that's made up of a couple of the lenders, senior level lenders, as well as members of the board of directors for the bank. And so for us, anything really over your lending authority goes to loan committee. And then anything over 2 million goes to our executive loan committee. And so, and that's an aggregate exposure. So if you have multiple loans, but you're a guarantor on all of those, then that's what makes up that 2 million. We'll get into that a little bit more, but asking the banker that you're talking to, what's your loan authority? Give me the process. How long does it take to get things to loan committee? Is always a good idea, getting a good time frame around that. So my husband always asks, like, what do you guys talk about in loan committee? Because he goes, I feel like it could be so subjective. Like, do you like the person? Do you not like the person? And that is true. There is some discussion on character, which I think is really important. But then these 5 C's of credit are what shows up on a credit memo. So these are the 5 things that every loan officer is getting to the bottom of. And so we'll go through these. And this is, like I like to say, is I'm kind of Oz. I'm taking the curtain back, and this is the Oz. This is the loan committee. We're all sitting around. This is what we're reviewing when we're looking over each credit memo that's brought to each week. So the first one, which I think is really important, and the reason why I think it's really important is because my specific type of lending is really more of a cash flow base. When you're a small business owner, majority of the time, there's not a lot of collateral that goes with your loan. So when I sit down and have that initial meeting, whether it's on the phone or on Zoom or in person, I'm really trying to figure out who you are, your why. Why do you want to do this so bad? What's the passion behind your starting the small business or growing your small business? And so it's who you are. So there's a whole section that I fill out, and usually it's paragraphs, and it's like an essay almost, that I fill in on who you are, what your business is, what you're doing, what your past is, things like that. So your experience and your reputation come into play. As the other piece to character that we look at is your credit score. And the reason why your credit score is important is because that shows what your past has been based on your payment history. I talked to someone this morning, and their credit history isn't great. And so to mitigate some of that risk for the bank, we ask for a little bit more down payment on their loan to mitigate the payment history. And he goes, well, how far back do you guys go? Because he had filed bankruptcy over 7 years ago. And I said, well, it's what showed up on your credit report, and your bankruptcy is still showing up on there. And so we can see anything. And he didn't realize that. And so having some of that knowledge, I think it's really important. And this is what I like to do every year around tax time. When I file my taxes, I like to pull the free credit reports so you know what's on there. Whether you did that on an annual basis, you can pull it from all three. You can do one different times of the year, whatever you want to do, but just knowing what's on your credit report. So if you do go to a bank and they pull it and there's questions, you already know the answers to those questions, or you could talk about it freely at the beginning. So the character piece to me, because I'm basically trying to sell you to committee. So on the capacity side is the ability to repay the debt. So that is cash flow. That is exactly what Ben just talked about, good debt versus bad debt. So we're looking at, okay, if you take on $100,000 of debt, how much revenue is that going to generate for you? And can your business support what that payment would look like? So what I just referred to on the business side is your debt service coverage ratio. Our bank, what we like to see for a business is a 1.25 debt service coverage ratio. I think it's easier to explain what a 1-to-1 ratio is. So if your debt service coverage ratio is a 1-to-1, that means for every dollar coming in, you're paying $1 to debt. So you're not saving, there's nothing going back into your business. So a 1.25 puts some money back into your business to pay all the other expenses that you have for operating. So that's what we like to see, a 1.25 or above on that. Your debt to income ratio is on the personal side. So basically what you do is take your annual debt service payment, your debt payment. So that's your car, that's your house, credit cards, boats, RVs, all of that, monthly payments that you have. That's not including bills or anything, but what would show up on your credit report. Take that annual number divided by what your annual income is. What we like to see on that side is about 43%, because that means 43% or less are going to cover all of your debt payments. Anything above that, that 57% allows for groceries, gas in your car, daycare, all those personal expenses that you have going on. So that's what we like to see on those ratios. Those ratios are really important. And so if maybe you're lacking on your debt service coverage ratio, that's when we may ask for some additional collateral, some additional down payment to lower that loan amount in order to meet some of those ratios. We always take into account other sources of income. So say you do have a small business, but you still have some W-2 income over here, or maybe you're in sales and so you have some other income coming in. We take all of that into account. We look at you on a global scale as well. It's not just your business or just you. We look at you globally, because what we don't want to do is for you to start a business and not be able to take care of all of the needs at home. So, and then I always want to throw rental income in there, because rental properties are a big deal right now and everyone kind of getting into that. So we do take that into consideration. We do normally stress that a little bit for vacancies, things like that. So it's not what you would think would show up on maybe your tax return or something like that, but we do take into consideration all sources of income. So your capital, that's really what your down payment looks like. Every bank is different, on those majority of the time. So what we're really looking at that is your loan to value percentages. What is your loan amount compared to the value of the collateral or equity into the project? So I get a lot of calls. People are like, I need an SBA loan. I need an SBA loan. And I'm always like, okay, why do you need an SBA loan so bad? And they're like, oh, they offer really great interest rates. And they do sometimes. It just depends on the program. And so we'll get into kind of talking about that a little bit more later on, but I just want to let you know that don't call into a bank and say I want an SBA loan, because you don't always need an SBA loan.
Whitney,
Ben always chimes in on that one.
Oh, that was always my biggest pet peeve as a banker. I will tell you as your banker if you need an SBA loan, but sometimes they are the product needed. Yes. I mean, it's definitely not a knock on SBA loans, because they are great products, but sometimes they aren't needed. Yeah. So one thing I want you to mention, how often, because it's on this slide, you've got credit score. For all of the people on here that are wondering, how often do you look at a business credit score, Whitney?
0.
Exactly.
That is our number one question. Thank you, Ben.
It is. And I will say, one time in 14 years, I looked at a business credit score.
Yeah.
Quote unquote credit score. It's really not, but bankers don't look at that.
Yeah. If you were a really big company and you had a Duns and Bradstreet number, that could be a requirement. But for the majority of the businesses where I am and the loans I look at, there is nothing. And so that's really the reason why we're looking at you as the person who owns the business, because you're it, basically, at the end of the day. And so that's why you are so important into the equation. So exactly, Whitney. Credit score of the person is all that matters. Yeah. So we've kind of talked through collateral a little. I've mentioned it at least a couple of times already, but you can go through here. And so it's basically whatever the lender can take title on, file something on. So if the loan defaults, everything just goes away, the business shuts down, this is what we can take back to repay our debt. And so that's why sometimes it's necessary to mitigate the risk for the bank to require more of equity into the project or more of a down payment, just because, hey, we're not really sure about that property, it doesn't look great, or hey, we see what your projections look like, the equity into the project, we probably need a little bit more than what we would normally require. I talk through all of that. I give all the whys when that's the case. Because when I'm initially talking to someone, I'm going to tell you what we have in policy. Policy states, if you're starting a business, and I may need 15% equity injection into the project, whether that's you've already purchased some equipment that you can prove. So if you want $100,000 loan and I'm like, well, I can do 15%. I can do 85% of that. So I can do 85,000, but you're like, hey, I already purchased 10 grand in equipment and did all these other things that come up to 5,000. I'm like, sweet. Yeah, let's document the file. That's great. That can be your equity. It doesn't have to be cash. So that collateral is important when we're doing our underwriting, because we look at the value of all of it. One thing I do want to mention is that UCC filing. So that is filed with the state. Normally what it's called is a blanket UCC filing, and that just says the bank has access to cash, accounts receivable. It's a big long paragraph, but basically we put it out there to let other banks know that we've already financed something with you. And so when we're doing our underwriting, we always pull that information of, is there any other loans out there? So maybe you forgot to mention that you had a loan at another bank. They filed the UCC. So then I started asking some questions about it. So I just always want to bring that one up, because that one is not a super common term until you kind of get into business lending. So really the condition side is, how are you going to use the money, and what are the market conditions at the time, what's going on basically in the economy. And so I'm going to talk about it because it's all over the news. Interest rates are increasing. I don't know if you know this or not, but they are going up. And so since interest rates have been so low for so long, people get a little bit of sticker shock when we start chatting. And I'm like, hey, this is probably going to be the interest rate on your loan. What are you talking about? And so Wall Street Journal Prime is moving up. If you are done any sort of research on mortgage rates are increasing, things like that. So we're really taking that into consideration. We are stress testing majority of our loans. If it is on a variable rate, which we'll talk about in a moment, if that rate does jump a whole point, what does that do to your cash flow? Because those are the things that people don't anticipate, and that can really, really crush a business really quickly. So we're doing what we can on our side to stress test that, to then I get that information from the analyst, and then I can sit down with my borrower and be like, hey, this is a variable rate loan. That's the only way it's getting approved. If the rate were to increase, I just need you to be aware that this is what your payment will go up to, just so we're all on the same page and there's no surprises at the end of it. So, and the economic conditions, it's a little crazy right now. Supply chain issues and things like that. So we're really paying attention to all of that and making sure that we're documenting it well and giving as much information to our borrowers as possible. Again, why I say, if I can't add value to our relationship, I will send you somewhere that can. I can do 1 to 4 family rental property investments all day long. Pretty simple deal. But what I love is we have another lender here, and that's really all he does. And so he digs into all the newspaper article. He's really in tune to that. And so he then passes that information along to his borrowers, which I think is the best thing any lender could possibly do. And so that's the reason why, again, finding the right banker and what you're doing is really, really important. I'll also tell you that one thing that, because I'm obviously not an expert in every industry, but we have access to some really good software where I can pull industry information, which I know SBDC can as well. But just to kind of give you some background, when I get approached by someone and I may not be really familiar with the industry, I can pull some information so I can get caught up to speed when we're after our initial meeting and go, hey, these are some additional questions that I think are important that I didn't ask the first time around. So I try to do as much research as well. So that economic conditions is becoming more and more important than it had in previous years. So does anybody have any questions on what loan committee looks like and what we're looking at as lenders on that side? No? Cool. Okay, we'll keep moving forward. The slide. Because everybody's question is, what is a good credit score? Literally, we get this all the time. And it really just depends. One question I would ask your banker is, every bank has a loan policy. So it's basically the rules and guidelines that we have to follow. I'm not saying that we can't break policy, but it has to be a pretty good reason why we would. And so for us, our bottom score for a commercial loan before it becomes a policy exception is 660. So we like to see your credit score 660 and above. I'm not saying we couldn't do the loan if it was below that, but I'm just saying there'd be a lot of questions, a lot of explanation that needs to go along with it. I hear a lot of times my credit score is an 850. Okay. And then I pull it and it's, 650. And they're like, I don't know why. So that's the reason why pulling your annual credit report across 3 bureaus is really important. We, on our commercial side, we only look at TransUnion. We don't look at the other 2. Every bank is different. Some pull all 3, some don't. And so your credit score will vary from each credit bureau as well. So, because some people don't report to every credit bureau, so some things show up and some things don't. So if it is a few points off, it is okay. It is okay. But just be ready to talk about it if there is an explanation that is needed. Okay, so this is kind of the meat and bones, in my opinion, to this presentation. This is really loan types. And so this is where I want you guys to look at it and go, okay, what makes sense for my business? Because again, I get a lot of phone calls and going, hey, I need an SBA loan. And maybe you don't. And so what I like to do is start with, tell me about you, tell me about your business. Let's kind of talk through and see what type of loan works, because we want to make sure you're getting into the good debt situation and not the bad debt situation. You're not using the debt to propel your business forward. It's just sitting out there. So the real estate loan, pretty straightforward. Real estate loans can be construction loans. They could be a purchase. There's owner occupied, which means that you will occupy 51% or more of the property with your business, not meaning that you couldn't lease out the 49% and be able to make your mortgage payment on that building. But your business would have to occupy 51% of it. There can be non-owner occupied. So basically it's a rental, a commercial property that's used for rental, which we commonly do as well. And then you can have a construction loan where you're building the building to your specifications if you have a very specialized need in that. And then there's a permanent mortgage on the property that switches to a principal interest. But I'm going to start with what I think this group would benefit from the most, which would be an owner-occupied loan. And I'm going to go over the loan terms. This is something, loan terms is really common to ask bankers, hey, what terms do you offer on this type of loan? And so on a real estate, on owner-occupied, remember, this is the building that you occupy 51% or more of the property. The loan terms on that can be the down payment is normally required is 15% down. That's a supervisory limit. So that's a regulation that we follow. And so we could increase that down payment. For instance, if the building is super specialized, then we would go maybe need 20% down or more. But 15% is what I like to quote people when I start the conversation before I see financials or anything. So 15% down. Right now, with this rate environment, we are not fixing rates for longer than 5 years. Just like you guys, we try to make sure that we maintain our profit margins. And the way we do that is we look at our cost of funds, which is usually our deposits, compared to what our loan rates are. So we got to make sure that margin stays within a certain percentage. And then, so right now, I would say we're probably 5% would be a safe number to say, throw out there, 5% for 5 years. But your payment would be based on a 20 or 25 year amortization. So that's what your payment would be based on, would be repaying that in 20, 25 years. So what happens, what a lot of people call these are 5-year balloons. So every 5 years, we can take a look at the property, we renew the note, we adjust the interest rate if necessary. If not, it's just a straight renewal, move on down the road kind of situation. honestly, there's not a lot of people that own a building for 20 to 25 years. So everyone always gets nervous when that's only 5 years. And I'm like, yeah, but if you really think about it, if your business is continuing to grow, you may move out of that building. And then you're renting it and making sure that the lease payments are covering your mortgage, if not a little bit more. And then you're going out and purchasing another building to continue to expand, or you're going to go build a building. And so that's the construction loan piece of a real estate loan that I wanted to talk about a little bit, because construction loans and a permanent mortgage are two different things because of the payment structure. So if you're going out and purchasing, that is a principal and interest payment. You're making a principal and interest payment monthly. On a construction loan, you are actually only paying interest on the balance of the loan. So as we move along in the project and your builder is building and you're asking for money, and we're sending it, and you're paying your builder and doing all the things that's necessary, you're making an interest monthly payment based on that amount. And then once construction's complete, then it can flip over to a permanent mortgage where that principal and interest payment begins. Terms on that, or rates usually are a little bit higher. We normally don't fix those as well, just because construction loans there's a little bit more risk involved, because if construction doesn't get complete, then we get back a building that's not done. And that's not really a good piece of collateral for us. Means that we have to spend some money and finish building it to sell it and things like that. So usually that's a little bit higher rate than what you would expect on a permanent mortgage.
And Whitney, one of the things that I'll say there on your real estate loan, it's very common for banks to fix a rate for 1, 3, and 5 years. That's the most common interest rates, I would say, industry wide. Now, I know that Whitney's bank in the past has done longer. Mm-hmm. And so it can always change, but 1, 3, and 5 years are how long banks typically are willing to fix interest rates. So I just want to mention that is a very common. I mean, if it's something different, it's actually the exception to the rule. If a bank goes 7 or 10 years, that's kind of the exception to what most banks will do.
And thank you, Ben, for bringing that up, because I also want to share one thing, give you a little insider tip. And when you're talking to a banker and you're getting terms, if they're willing to fix the rate for 7 to 10 years, you need to ask what the prepayment penalty would be on it. Because so the bank is fixing that rate for a certain period of time, for 7 years, say. So they're budgeting based on that interest income coming in. And if you pay off early, sometimes if it's out of cash flow, sometimes there's not a prepayment penalty. But if you go refinance or do something else, they will charge a prepayment penalty because they want to recoup that interest income that they've already planned for. So that is one thing that I would ask if they are quoting long-term fixed interest, say, can you tell me what your prepayment penalty would be on it? And then you'll really surprise them. It'll be great. So catch them off guard a little bit. And that's really the purpose of this presentation. Is I want you guys to be able to go talk to a bank and feel comfortable. Don't be intimidated. Don't walk in and say, I don't know what I'm doing. You don't need to preface anything. You know what you're doing, and I just want you to feel comfortable when you're walking into that situation. So the leasehold improvement loan. So that it's similar to a construction loan, but it's based on if you're renting space. So you find a space that you want to rent, and the owner of the property, the landlord, will white box it, meaning that you get white walls, literally a box. And then they say all the tenant improvements are on you. So you come to me and say, hey, I always use 100,000 because it's just easy math for me. I need $100,000 loan because I need to put some equipment in, purchase some inventory, do some things. I said, okay, that sounds great. So we kind of worked through it. Normally there's not as long of an interest only period. Usually that's about 90 days. And the reason why, what I always like to say is, how long does the contractor think that the tenant improvements are going to take? So we take that, they say 60. Okay, great. So that's going to take 60 days. So you're not going to be open for 60 days. Then I like to add on at least 1 month of interest only again, because I'm just gonna be real honest with you. Usually that first month, you're not making enough money to service my debt. So to watch that. 3 months is common, 6 months is really common. That's what I like, because construction always takes longer than what it should. So then I'm not going back to committee to have to get the loan changed. And it gives you some ramp up time. It gives you time to get people in the door or your inventory out of the door in order to start getting some revenue to make that principal and interest payment. I will tell you though, the term of my loan has to match what your lease is. So if your lease is 5 years and I give you 6 months of interest only, that means that I'm going to set up my the principal and interest payment on 4.5. Because at the end of the 5 years, you may move out of that space because you need a bigger space, and then all my collateral is still left in there. So I have to get that loan paid off within that time frame. But similar, 6 months interest only, and then it flips to principal and interest payments. So that's a really common one, and that's actually one of the really common ones that I usually will require an SBA guarantee on, just because it mitigates a lot of risk on my collateral. So Ben mentioned this earlier, a line of credit. So a line of credit is really good for short-term working capital needs. So when I say working capital, I'm talking about expenses going out in order for your revenue to catch up. And so it can be used for really anything that you need, but it has to get paid back down. So it moves up and down throughout the month. It can be zero for the month, but the bank wants to see it move up and down. And I set lines of credit up on 12-month maturities, meaning every 12 months, you and I are sitting back down. I'm gathering new financial information to renew the note. The big piece, the reason why I like to do that is because I want to see what the movement was. Because, in my loan portfolio, I have lots of lines of credit, and I'm not monitoring those on a daily basis. But at that 12-month mark, I can go, hey, you really ramped up at around Christmas. So you needed a ton of inventory. You really ramped up around Christmas, and then the sales didn't catch up. And so your line of credit hasn't moved back down. You haven't paid it back down like what we discussed when we originated the loan. You're like, yeah. Give me another year. Let me work on it. And normally the conversation goes, that's fine, I can do that. But I just want to let you know, if this line of credit does not rest at zero throughout this year at some point, then we may look at terming that out, because it was more of a permanent working capital need, not a temporary working capital need. Those interest rates are higher, I will say as well, and it's variable. We base our rates off of Wall Street Journal Prime. I think that's another good question to ask your banker as well, is what index do you use to price your loans? Wall Street Journal Prime is really common. So you're paying interest monthly, and then we just look at it every year. And if you're using it, great, and this is what you needed, perfect. That sounds great. I always recommend a small business to look at getting a line of credit, because if it sits there at zero, you're not paying interest on it. So if you don't use it, it's no big deal. I will tell you that we do charge renewal fee and doc prep fee on a yearly basis. It's usually less than like $400. So it's kind of peace of mind for you as well. The last thing that you need to be doing as a business owner is waking up on Wednesday, knowing you have no deposits coming in Thursday and payroll's Friday. That's when you could hit your line of credit on Wednesday and say, hey, Whitney, I need 10 grand moved over. I have payroll hitting on Friday. And then you chip away at it, or those invoices start getting paid, and you're great, and you pay down your line of credit. So it moves, and that's the purpose of it, is to be able to be flexible for what you need it for at that time. And then the last one is a term loan. Startup, if there's a piece of equipment that you need, these are principal and interest payments that are being made on a monthly basis. The term of the loan is usually based on the useful life of whatever you're purchasing. So, if you're getting a lot of computers and things like that, I usually try not to do more than a 5-year repayment on those, just because they're computers. But say you're getting a big, heavy piece of equipment, and so that may be a 10-year repayment that you need on that, because it's, you're like, I'm going to take care of it. So similar, I always refer to these more like, it feels like more of a car loan. The rates are usually fixed. You're making your principal and interest payment monthly. Just to keep so again, some good debt for your business, because you're going to make money from that purchase or that need. So I see the chat popping up. So is there some questions out there?
Well, there's been some pretty simple stuff, and I'll start by saying, the line of credit from a banker's perspective, it needs to look like moguls. It needs to go up and down. It should never be flat unless it's zero. The bankers want to see it being used, not staying all the way at the top, because that's when she's going to term it out. Whitney says, okay, we got to make monthly payments on this. The other thing she mentioned, it's a insurance policy for a small business is what it is. When it's, hey, I got to make those payroll, it's really just an insurance policy, or can be. So a couple of questions and I think I've kind of answered them in the chat, Whitney, is what would be a good loan for purchasing products? And he sells and makes his own barber salon products, and a line of credit would possibly be the best product for you, to buy the raw goods and then change it over. And as I said, that's something that, we can sit here and talk general information. You've got to sit down with the banker. Whitney can help you. I can help you and say, more than likely this can be the product. But here's the thing, unless you're going to Whitney to get the loan, what she tells you may not be what your banker wants to do.
Mm-hmm.
Your banker may say, I don't care what somebody else said. I'm not doing a line of credit. I'm doing a term loan for this. Every single banker has a little different philosophy. I was real big on Whitney on line of credit. I loved them. Some bankers aren't. Mm-hmm. So, do you need collateral to open a line of credit from Andrea?
It depends. And I say it depends because it depends on how much you're needing. And that's really where it's important to sit down with someone from the SBDC, your banker, and see what you really need, how much you need on it. Because if it's a significant amount of money, so like, I'll give you even better. So like, if it's like 50 grand, I would probably want some collateral. If it's 25 grand, probably not, but I would want to get an SBA guarantee on it. So hopefully that kind of gives you some guidelines to follow.
Yep. What about VA loans for purchasing investment owner occupied property?
So I will tell you this, I'm not a mortgage expert. But especially on the VA products, I am not aware of any VA products that do commercial properties. I am aware of VA mortgage products for 1 to 4 family.
Yeah, and there are some veteran programs through SBA, but I don't know that I don't remember what the dollar amount on those are. If there's a threshold that the veteran gets a benefit. But happy to meet with you offline and see what we can do, Phil, on that. Joel just sent one for a startup, receiving a loan for a truck, tractor, box, and a stash for maintenance and insurance. Buying through a dealership is draining. Could you get a business loan for that and pay over a longer period of time rather than $1,000 weekly through a dealership? So a semi-loan. Basically.
Yeah. Yes, you could look at doing a term loan on a semi.
Yep. RT 660 is the minimum credit score for her bank. Every bank has a different minimum. The bank that I worked at, we technically did not have a minimum. And I'll say that my philosophy as a lender was, if there is a good explanation of why your credit score is why it is, I don't care what that number is. It's going to cost you a little bit more on the interest rate. But let's say that you were a customer of the bank and I had a couple loans with you and you got sick and you either didn't have health insurance, or maybe you lost a job due to it. You were out of work for 6 months and you drained through all of your savings. You're back on your feet for the last year. I still may make you that loan at a 600 credit score. I mean, every bank's a little bit different on that. So you need to just talk to your bank. And Whitney, would you say that your best opportunity for a loan for a startup in particular is a bank that you have a personal relationship with?
Yeah, and I was going to thank you for the segue into that. So yes, what I would say is where you're currently banking, even if it's just your personal account, that's where I would start, because they're going to have the history with you. They'll be able to see what your average deposits are. Are you overdrawn? So that's where it's important to also take care of your checking accounts, because on the loan side, we look at checking account information at our bank for sure, for our current clients.
Awesome. Johnny asked, what is your perspective to how important is a business plan for a new startup or major project loan from your bank?
One of the most important things, because that's your explanation. That gives me a ton of background on where you're going, where you started, all of that. And that and your pro forma. So I asked for a pro forma a lot, and people, I think, get very frustrated, annoyed with me on that, because they're like, well, I've been in business for 5 years. I understand that, but you're also adding something, a new service to your business. And so I want to see how that affects your current business just as much as what it looks like moving forward. Because I was talking to someone, and he is a tech company, and he wanted to add consulting and some other services, and it tanked his current business that was doing really, really well, because it added a ton of expenses to his business. And so in order for you to sit down and do those things, number one, it shows me that you care. It shows me that you want to do the work that it takes for the small business to be successful. And number two, and then pro forma wise, I dig into those so hard, and I ask a lot of questions. How did you get that number? Where did that number come from? Why did that number change so drastically? Why did it either up or down? Either way, and really being conservative on those is important. If you walk in and you're like, oh, the first year I'm going to make $1 million, I'm going to go, how? And I'm not trying to be rude. I have to be realistic, because again, my goal as the loan officer is to mitigate as much risk as I possibly can, so the bank doesn't lose money on making a loan.
And I agree with you 100%. And Johnny, the thing I would say on that is, for a startup, a business plan is very important for a bank. Loan from a bank. If you've been a commercial customer of that bank for 10 years and you've borrowed, $1 million over the last 10 years and you've paid it all back, and all of a sudden you want to borrow $1 million, they may not need a business plan. They just may need those pro formas, which that question was asked. The explanation of a pro forma is a projected balance sheet or income statement. It's what your income and expenses that you're projecting for typically 3 to 5 years. How do you expect that money to come in? What is that money going in and the money going out?
Mm-hmm. Exactly.
Timothy, great question. Would you need the credit score of all partners to be above 660 if the startup is a partnership or LLC?
Great question on that. So I'm going to dig a little bit deeper into that. And so on commercial loans, our bank policy, and this also kind of goes into SBA stuff, anyone that owns 20% or more of the business is required to guarantee the note. So yes, we would pull credit scores on anyone that owns 20% or more of the business. And I will tell you this from experience with a client at one point, the bank required that if we were going to do the loan, that we would get an SBA guarantee. And that particular company, one of the owners, was a little bit nervous about going through the SBA, and so they removed her off of the business. We receive annual financial statements, tax returns, profit and loss balance sheet on our loan portfolio, all of our commercial customers. I received the tax return, and that person is now a 20% owner in the company again. So guess what? She has to be added to the loan because she owns 20%. And so I'm giving you that example because don't remove someone just because you don't think you will qualify if you are just going to add them back on because the bank does find out. You can't really sneak stuff past us, unfortunately. And then there's a whole dishonest thing. And I want to trust my clients, and I want my clients to trust me. And so make sure you're being open and transparent with your banker on that stuff. So I say that just because of personal experiences and people trying to negate things. It will eventually come back out. So. Any other questions?
Okay. What if no one owns more than 20%? We're worker owned right now. We each own 10%. Boy, these are fun. Oh, Whitney and I are going to love this one.
So it can vary. I'm going to ask a clarifying question. How many so do you have 10, obviously 10% owners? Okay.
Yep.
Then yeah, I would honestly ask all 10 of you to guarantee, just because you're all the same owner percentage. And on that note, I will also say I would require unlimited guarantees, meaning each one of you would be responsible for the loan. You would not just be responsible for your 10% share. That's negotiable, but that's what I would say.
100%. And here's another thing. If you are trying to, let's say that it's that mom is willing to help you out and she's going to be a partial owner, but she doesn't want to guarantee the debt. And the banker says, well, anybody who owns 20% or more has to guarantee the debt. And so you say, okay, mom, you're going to own 19%. Guess what the bank's going to say? She has to guarantee it because you only gave her 19% to get around our rule. A lot of times that happens. Mm-hmm. Don't try and, the bank will work with you. Don't try and slide in and hide something from the bank because they're going to say, nah, this isn't right. But when you're a 10% owner like that, Terry, everybody's going to have to, more than likely. Yep.
And I did do a deal where we had like 30 guarantors on it, and we did a pro rata share of each guarantor to get we actually did 110% of our loan amount, and unfortunately the loan did fail, and so I had to go to each one of those guarantors and collect. We did a workout plan with them, which was fantastic. Some of them wrote a check. Some of them we did a loan for that dollar amount guaranteed and got it repaid that way. So, not saying that there's not ways to get around it, but depending on what your loan, depending on your loan amount, strength of guarantors, there's a laundry list of things. But if you and I were having a very initial conversation, I would see everyone guarantee, and they'd be unlimited. So they would be fully responsible for the full amount of the loan if the loan defaulted.
Yep.
Okay. SBA lending. So first off, I would say go do your research. Go to sba.gov, do your research, because there's 2 different programs. And I think people don't realize that there's 2 programs within the SBA, dependent upon what your needs are. Right now, I have a rash of 504 loans, and which is great. I love 504. It's a different program. It's for owner-occupied real estate, where the bank takes a first mortgage on the property. The SBA does a second mortgage. So the first mortgage you pay to me based on my terms. Second mortgage is based on SBA terms. And then your down payment can be 10%. There's a lot of caveats to that if you're a new business, so on and so forth. So a lot of times, like I have one right now, and we're doing 504 on it, and they are required to put a little bit, the 15% down, because it's a specialized building. I have another one that is going to go 504, and they don't have to do 15% down because it's not a specialized building, and their business is older than 2 years. So that's a really good program. That's really the one I like to do when it's owner occupied, just because that second mortgage, their rates are usually less, and they'll fix them for long periods of time. So that's a really good program to look into. And then there's 7A. It's the other one. The 7A is different because on the 504 program, you're making your payment to that second mortgage to the SBA. What people don't realize is when I require an SBA guarantee, you're still working with me. There is no payment that goes to the SBA. So the bank, the process to apply with me is the same. What changes is I take it into loan committee, and someone goes, yeah, it's a new business, not enough collateral. Let's mitigate our risk, and let's get a 75% SBA guarantee on it. So then we go to the SBA, give them all the information they need. They do their underwriting. They come back and say, hey, your loan's approved. I wish it was that simple. I really simplified it. But then they come back and say, okay, we guarantee 75% of the loan. That guarantee only comes into play if the loan defaults. And if the loan defaults, then I can go to the SBA bank and say, hey, loan defaulted. We want you to pay the $75,000 of the $100,000 loan. We still carry our 25%. So when I get a lot of phone calls and people go, I want an SBA loan. How do I apply? With me. And then we make that requirement. And there's 3 different guarantee percentages, 50, 75, and 85. 85 is for loans of lesser amounts. 75 is pretty much the normal. And then 50%, a lot of like the smaller deals, I will do that because it's usually a 3-day turnaround. They don't do any of their own underwriting for that. It just moves the process along a little bit quicker. Still a 50% guarantee. So if I'm doing a 20 grand line of credit, they'll pay 10 grand. We figure out the other 10 grand. Normally what we like to do on those is whatever our portion is to work with our borrower and figure out a payback for it. So I just really wanted to go through those. I like to mention them. Also like to say, don't call the bank and say I want an SBA loan. I definitely think you could say, hey, I know you're a big SBA lender. I'd like to explore that opportunity if it helps me. A lot of times when I get an SBA or an SBA guarantee is required, I can lengthen the term of the loan, but you don't always need the term to be 10 years. You don't always need the term to be 7 years. I know sometimes that feels better, but let's pay off debt as quick as we can. So then we get more cash flow, and you can then move to that 5-year plan of what, adding another service or whatever quicker. So it's not always required if that longer term isn't. And then there are rate caps on SBA loans. If I'm getting an SBA guarantee, they're usually higher than what I'm going to charge anyway. So you're not going to save anything on the rate for me. So just SBA.gov. If you have any further questions, we can definitely chat about. I just like to hit on that a little bit. So everyone has a good idea when a banker throws out that information. So I'll move on to the loan application. So this is when someone says, hey, I want to chat. So we have our initial conversation, and they go, okay, well, what do you need from me? And I said, let me email you because it's a list. So here is the big list. So the borrower or the borrower, if that is a company, then this is required. The last 3 years tax returns, if they're available. If it's new business, obviously not, they won't be. Or say you filed, you've been a sole proprietor, so you filed under your Schedule C, so you wouldn't have this. That's completely fine. An interim financial statement, if it's an existing business, like right now, tax returns were just due. Some people apply for extensions. So when I say I need an interim financial statement, what I would need is a 12/31/2021 financial statement, and then some sort of balance sheet and income statement from 2022. That just helps trend for us. Pro forma projections, that is always required on any new business. I'm not saying I wouldn't require it on something existing if I felt like it was warranted. The first 2 years are broken down monthly. The third year is annualized. And I'm talking, I want to know every revenue and every expense that's coming in and out. Your business plan. I honestly read through it. I use paper for this. I print it and then I read it, highlight questions. And so when we get on the next call, I have all of that in front of me. Your entity documents, so how you have your business set up, operating agreement, certificate articles, so on and so forth. If you are doing any sort of construction, tenant improvement, things like that, I will need plan, specs, and budget. I will need to know where every dollar is going on my project. And then if you're purchasing equipment, I need an equipment listing of what you're purchasing and the price. I would love to get quotes if those are available. Those aren't always available, but that helps with my file as well. And then a guarantor, anyone owning 20% or more of the company. I need your last 3 years tax returns. This helps us see what you have made previously. So if the business, for whatever reason, cannot support the loan, then we can see what your income is. I get a lot of questions about this, and I think this is a really good opportunity, good place to talk about it. Because I get a lot of people that go, okay, I'm just going to quit my job. I'm going to start this business. Okay. This personal financial statement becomes vital to getting your loan approved. So my recommendation is if you want to start a business and you are going to quit your W-2 income to start this business, so you will have no income coming in, on your personal financial statement, I want to see some savings. I want to see that if you cannot pull money out of your company because you are making your expenses, you're paying your expenses for the month with your business, with that revenue, if there's not enough left over at the end of the month to pay yourself, that you can meet your obligations at home. I get that question a lot. I hate when we get really far into the process and then that's brought up. So I'm trying to get better. It's a learning process for me of asking the right questions up front. But I want to see a strong personal financial statement. I'm also not saying you have to own a home. I'm not saying you have to have huge net worth. I'm saying I want to look at your checking accounts and I want to see that you can meet your debt obligations at home. And then last but not least, as your resume. So let me go back to personal financial statement. That is your personal balance sheet. So that's your assets and that's your liabilities, and that creates your net worth. Most banks, all banks have a form, a template for that. You can also get one off the SBA.gov website, and it's fantastic. And it goes through, it's really, really good as well. So I think it's form 413. It's called a personal financial statement, and you can get and look at one there. You can also email me and I can email it to you. So either way, but I want to reiterate, make sure if you are going to be starting a business that you have your home set up well enough to support it. Questions? I feel like I saw some stuff pop up. No?
Nope, it was from Cindy, so we're good to
Cindy.
go.
Okay, perfect. Well, hopefully we finish a little early so we get some questions in. So business plan. I look at them, I read them, and I'm not saying they have to be a certain page number. Like, if it's 20 pages, cool. If it's 4 pages, cool. It's however you can get the information over to me. These are some of the things that are in there. I think marketing is always an important paragraph. Just if you're spending marketing dollars, what is your return on that? What are you expecting to return from those marketing dollars that I could be financing? What is your competition in the area? I want to make sure you've done your research, who's around. I'm going to do some. So make sure that it's there. When I talk about operating procedures, personnel, that is who if you are not going to be running your business, who is and why? And why are they in that position? Things like that. Those key people that are going to be in the daily running of the business. And the reason why that's important is sometimes I like to sit down and talk to them, number one. Number two, maybe those are the people that I really need to be communicating if I have specific questions. So what that looks like, obviously financial information, that break-even analysis, that is, SBDC does such a fantastic job on that. And so what that means is how much money do you have to make to break even with your expenses? And so we stress test that. A lot of times when we get your pro formas, we stress it and go, okay, what if revenue drops by 10% and expenses go up by 3%? What does that look like for their business? So we look at that quite a bit. You need to make sure that you're footnoting on your pro forma and your projections on any assumptions. That, okay, by month 4, I'm expecting to add on 3 clients. So that means I'm going to need to hire another admin. That's going to increase my expenses, but it increases my revenue this way. I'll probably have to pull my line of credit to make that first month, because we're not going to invoice that. We'll invoice that first month, but we don't expect payment for till the next 30 days. All of those assumptions need to be put in there. Are you expanding? Will you be making some big capital expenditures that you will then do some depreciation and things on? So all of those assumptions, which is, to me, honestly, the fun part about all of this, because that means there's growth. And so you're looking at, I'm going to start this business. The first couple of years aren't going to be great, but by year 5, I'm going to be up, running, moving, and we're just going to, the sky's the limit. So these assumptions I really like digging into a lot as well. So to kind of give you a little background, there's a lot of business plan. Also preface this, I cannot help you with a business plan. You have to use someone else. I will pick it apart, but I can't help you with any of that.
And the one thing I'm going to say on your business plan, if you put in your business plan that everybody is your customer, then that means that nobody is your customer. Yeah, the bank's going to look at that. If you say, well, everybody needs my product, unless it's water, food, electricity, not everybody is your customer. So make sure that you have good information for stuff like that. And so that's the end of the presentation. There's my contact information and Whitney's as well. But we do want to open it up for additional questions. So if you have additional questions, please put them either in the chat, or we may even have a minute that we can open it up to. If you want to unmute and ask that way, that would be fine as well.
I want to say thank you, everybody, for attending. I absolutely love this presentation. It's the highlight of my quarter when I get to see everybody and really honestly talk about something that I'm really, really passionate about. And with SBDC, you guys are fantastic. There's all my contact information. That is my cell phone number. It's the easiest way to get a hold of me. So some people are hesitant to call it. Feel free to call. As you heard in my intro, I do have 2 young children. So if it's after 5, I'm usually unavailable, but I get back to you the next day. Also, feel free to text. Some people are more comfortable texting. I can do that as well. So again, thank you so much for spending this almost hour and a half with us. I hope it helps your small business, or at least get you thinking about moving forward on it, because we need all the small businesses we can get.
Awesome. And Cindy put up a poll. Oh, go ahead, Cindy.
Well, we had a question that came in, and I think it was sent to me directly, but I'm going to go ahead and ask it out loud. The question states, if we submit all the required information needed for one of these commercial loans discussed for a particular project or loan, and this loan does not go through to completion, perhaps because of a disagreement on final terms, how much of this application, which may take a lot of time to compile, can be used for looking at another loan at the same bank?
All of it. Yeah. That happens all the time. I also tell people that don't feel obligated to send it all at once. Like I'll create a file and I'll stick the information in there until I have a complete file, and then we can sit down and have a conversation. Or I have someone right now that sent me over really basic information and said, is this even feasible? And so I'm able to do some little things like that. But yeah, I mean, I don't get rid of anything. If you drop it off and it's paper, I scan it in. And if you direct me to, I will shred it. But I don't get rid of things at all. So I pull files back from a couple of years ago out of other people's files that we have here at the bank, and get tax returns and financial information and things like that. So that is really common. No need to recreate the wheel. And I also have people that are talking to multiple banks. And so they've gathered it for one, then very same thing. They weren't happy with the terms. And so they just forward that information over to me.
We had a question about the presentation. You will receive, as long as we have your information, as long as you're not iPhone and haven't told us what your real name is, we will be sending out a copy of the presentation, hopefully this afternoon, but possibly tomorrow. But you will get an email from me with that information. And so we have a question that came back up about the credit score, Whitney. So I'll see what your bank's policy would be on this. If one partner has a credit score below 660, but the other three partners are above 700, they're all 25% owners, how would that affect the loan?
Honestly, not a lot. We would just need the explanation on why.
Yep. And
so
understand
one person won't kill the deal.
Yeah. Especially if the other three people are strong, financially, have good personal financial statements, tax returns, if everything else looks good. Sometimes credit score can be an exception to policy on certain things so I would never tell anybody to just say, I can't get a loan because of my credit score. Go in and talk to the bank. I don't care if your credit score is 550. Go in and talk to the bank and say, okay, what do I need to do to get my credit score to 660? They'll give you that advice. They'll explain to you, here's what you can do. So go in and talk to the bank.
Yeah, and that's really common, honestly. If someone has a really great idea for a business and they're like, I know I'm not the strongest, and they go find someone that's interested in investing that is strong. And so then they create this business together. And the reason being because the other person's strong. So I would not hesitate to talk to a bank and go ahead and apply for a loan if you need one.
Awesome. Any other questions? I'm going to go ahead and stop sharing my screen here so I can kind of see everybody that has their cameras on. Any other questions that people have? And you can unmute if you would like to. Okay, well, okay. Should personal big purchases be put on hold until after you've closed on a new business? Great question.
That is a really good question. So we pull credit once. We don't pull credit prior to closing or any like you would. That happens maybe for getting a mortgage. But I would strongly encourage you to really think about those things prior to starting a business. Maybe you do those purchases first and hold off on starting your business. The last thing you want to do is put yourself into a situation where you can't make payments. So, I mean, I'm not going to tell you you can't go buy something because I can't. But I would strongly encourage you to really sit down and go, okay, what does my home look like if I'm going to start this business, and how do I make sure I protect that prior to?
Yeah, I agree with Whitney on that one. I would be very hesitant to recommend going out and financing a new vehicle or buying a new house while in the process of doing a new business. Starting a new business is hard in and of itself. And if you've got additional debt that you didn't have initially, that could definitely make it harder. Um, Here's another question. Can a startup business be pre-approved for purchasing or renting a building before they find one?
It's really hard to do that because there's so many variants on that, depending upon your lease. And I had someone come in not too long ago and say, well, I won't even have landlords talk to me if I'm not pre-approved. And I've never heard of that. And so I would push really heavily back on that because a lot of there's such a difference between getting a commercial loan and getting like pre-approved for a mortgage, because there's so many variables that go into it, especially if you're doing a startup business, that you need to know what your needs are for your space. That's where you need to start. Don't start with the loan, and be realistic on your loan. And that's a lot where the SBDC can come in and look at your pro forma and have an idea of what your business loan, what the business can handle on a loan payment.
Excellent. Okay. We have just a couple minutes, so if there's any additional, okay. I'm looking to refinance my 2 LLC loans for better rates or conditions. I need some contacts or leads for this. You need to just talk to your bank or another bank. We're not going to recommend any bank. I'm not going to recommend Whitney.
Yeah.
I'm going to tell you, talk to whatever banks you're comfortable talking to. And Whitney's going to say the same thing. If the loans are with her bank and you aren't happy with the rate, talk to somebody else.
Yeah. And my only recommendation would be to find some in your community. Yeah. Since, this goes out to the whole state. So find someone in your community.
And the reason for that, more than anything, is, if you're banking in your community, and it doesn't matter if you're in Ponca City, a town of 20,000 people, or give or take, or if you're in Oklahoma City, the fact that you can walk in and talk to your lender when there is a problem, because at some point, every business has had a problem. When you can sit down face to face and talk through that with them and say, what can we do together to make this get through these hard times? You can do that. If you're at an online bank, it's real hard to talk to the same person twice. And so local, I won't say is 100% always better, but 99.9% of the time, it's better to be at a local bank, somebody that you can go in and talk to. Great question. Okay, well, doesn't look like there's any other questions.
I had one question.
Oh, yeah, please.
Thank you guys so much for doing this for us. I've learned a lot. I was just wondering, do you guys have any information on grants specifically for, people in Oklahoma? I've kind of tried searching, kind of run into some dead ends. I didn't really find anything specific for Oklahomans, but I didn't know if you guys had any information on that as well.
Okay, be the bad guy here. Honestly, unless you are a nonprofit, it is almost impossible to get grants. For-profit businesses, unless you're solving global warming, it's about impossible to get a grant. I hate saying it, but it's the way it is. I really don't know what else I could say on that. It's just very hard.
I don't waste my time.
Yeah, I hate saying that, but it's just pretty much impossible.
Okay. Well, thank you for letting me know that.
Mm-hmm. I hate being the person that says that.
I know. I was like, I can say no. But yeah, I get asked that question a lot. And unfortunately, they're just not out there. There's not a lot of that around. So, but well,
And if I'll say this real quick, if you want to go to grants.gov, you can search through, and I won't say you can't find one, but it's just odds are against you. When I tried to acquire business just to get an idea of what the rates and terms are via SBDC, I had several institutions contact me and offer them. I'm looking for similar offering to refinance, like a marketplace offering. Did you? I'm guessing you maybe went to an SBA, like a lender deal. A market. There's online places that you can go and get rates. Like I said, we just would not recommend that typically. Okay, well, Whitney, thank you so much time. As I love this presentation because it's something that I do understand, and I think it's great information for all of our clients. So thank you for that, and look forward to doing it again in 3 months.
That sounds great. I hope everybody has a wonderful day. Thanks so much for your time.
Thank you.
Recording stopped.